Good morning, students. Welcome back to the session on Ind AS. So today we are going to continue with our discussion on financial instruments. And today we'll just continue with our discussion in relation to the topic that we picked up yesterday, and that was about embedded derivatives. Yeah. So without discussing further on this embedded derivative, we can begin with the illustration in relation to the embedded derivative, which I suggested that you should also attempt once, or at least you should go through that once. And I'm just hoping that you would have revised all the things that we discussed yesterday. Yeah, derivatives you remember, host contract you remember. Yeah, so now for the purposes of our accounting, what do we need to remember always? Whether the embedded derivative should be separated or not. Yeah, and if that is separated, how it should be accounted for? If that is not separated, how should the hybrid instrument be accounted for? Okay, yeah. So these are few things that we'll have to just now further understand in more detail with the help of these illustrations. So you should now get on to illustration number 5, which is page number 12.136. All right. So now this is about the prepayment option, which is in relation to borrowings obtained by the entity. Entity PQR borrows rupees 100 crores from CFDH Bank on 1st of April 2000 tax 1. Interest is payable at the rate 12% per annum. So PQR has taken a loan for 100 crore. Interest is payable at the rate 12% per annum. And there's a bullet repayment of the loan at the end of the term, which is 6 years. So term is what? 6 years. So that means principal would be paid in one go. The loan includes an option to prepay the loan at 1st April each year with a prepayment penalty of 3%. There are no transaction costs. Without the prepayment option, the interest rate quoted by the bank is 11% per annum. Now in this case, there is a prepayment option. That means for 6 years. This is 6, this is 5, 4, 3, 2. That means on 1st of every year, if required, loan can be prepaid. But if the loan will be prepaid, then there will be a penalty of 3%. If we go with all of these options or with this arrangement which has been agreed, then the interest rate is 12% per annum. But if the borrower will not get any prepayment option, then the interest rate gets reduced. From 12, it becomes 11% per annum. And let's understand the logic around this. Why should the interest rate go down? In the current situation, PQR has an option. An option should have a value. Option should have a cost. Correct? Yeah. Option is what? Option is a derivative. So any derivative will come with a cost. This cost will not be significant, but yes, definitely the cost will be involved. And if the bank will give any party any option, then the bank would like to charge something. So this increase in interest rate of 1% is for what? For giving this option. Now a question may arise that What if PQR has not availed the option throughout this period of 6 years? So as we discussed yesterday, it's not necessary that the option will be exercised. Having an option will include a cost for the party which is getting the option. Yeah, having an option will include a cost. So it's not necessary that if the option is there, it has to be settled. Even if it goes expired without exercising, still that should have some cost, okay, which is clearly visible in this scenario, right? Now we are required to analyze this. So that means what do we need to do? We need to check about the embedded derivative, about the host contract, about the hybrid instrument, and then we also need to comment about the accounting requirements in this scenario. All right, yeah. If any of you has been able to solve this, if you want to share any thoughts on this particular example, because I understand that you would have definitely practiced this once. So I would wait for your comments first of all before I begin my discussion in terms of solutions on this. So quickly, over to you. But you should not take so much time. Quickly, if you want to share any thoughts on this, please let me know. And after this, I can just move further. I'm waiting for responses on this. Yes, quickly. Yes, any thoughts from your side? Any doubts or any problems you might have faced on this? Or if you have been able to solve this, the solution and the reasoning which you would have picked up for the solution, it will be good to understand about all of that. Yes, quickly. I'm waiting for a solution. Any thoughts from your side on this? Please let me know. Any thoughts? If you don't have any thoughts, then we can just continue on this. Now, if you look at this contract, what's the first step? First step will be to identify the host contract and the embedded derivative. I think that's a very simple thing for us to do. Host contract and the embedded derivative, I'm sure all of you would know. Yeah, all of you would know. In this case, what's the host contract? This debt. Yeah. So if you look at this arrangement, excluding the prepayment option, what is that? It's a debt instrument. So what's the host contract? Debt instrument. Yes or no? Yeah. And do we have any derivative? Yes, we do have an embedded derivative, which is in the form of prepayment option. Correct? Yeah. Okay. Now what's the next step? Next step is about the accounting. So now we need to determine the amortized cost of the host instrument. Now the host instrument is a debt instrument. And what is a debt instrument? Financial liability. And if we look at the classification of this financial liability, where would it fall? It would fall under amortized cost. Correct? It would fall under amortized cost. So how do we account for this instrument? At amortized cost. So now we need to get on to the amortized cost of this debt instrument. So you can just go to the solution also, please. Yeah. So from the solution, we'll just read some of these points. Whether the prepayment option is likely to be exercised or not. Amortized cost of the debt instrument should be calculated as present value of expected cash flows using a fair market rate for a debt without prepayment option. So how do we calculate it? How do we calculate it? So we have prepayment, which is equivalent to 12 rupees. Sorry, we have payment equivalent to 12 in the first year, then 12, then 12, then 12, then 12, then 12 plus 100. Yeah, the numbers are in crores, and these are the years. So that's why I'm putting those in boxes. So these are the cash flows, correct? Now about these cash flows, what do we need to do? We need to discount them. You remember the present value of a financial liability? So the same thing will have to apply. And how do we compute the present value? Present value will have to be computed at market rate of interest. Market rate of interest for this particular instrument. We should not blend this now. We should consider only this instrument and we should check what will be the market rate for this instrument. That is 11%. So how do we discount all of these cash flows? At 11%. So this will be discounted. Then this will be discounted. Then this one. Then this will be discounted. Correct? Yeah. So this way, all of these cash flows will be discounted. So you can look at the solution which is given in the study material. So the present value for all of these amounts comes out to 104.22. Present value comes out to 104.22 crores. Yeah. Correct? Yeah. So this is the present value which we get. Now on this present value, what do we do? On this present value, we will accrete interest. So let's accrete interest on this. Just 1 minute. I'll also solve this. So in the first year, what do we get? Now I'm just clearing this part. In the first year, interest will be 104.22 into 11%, which comes out to 11.46. Okay, this comes out to 11.46. Now what do we need to do to this? Just 1 minute. So this is 11.46. To this, what do? We will add. And we will add the principal, that means the present value, and we will reduce the payout. We will reduce the payment in the first year. Okay. Now on this amount, we will compute the interest for the next year. Let's understand how is this computation done. Now at the end of the first year, what do we have? Principal equivalent to 104.22. And in the first year, interest came out to 11.46. In the first year, what has been the repayment? It's 12. So what's the balance? Can you all compute this balance? and share with me. I'm getting this balance of 103.68. How do I get this balance? Principal plus interest minus this amount paid. So we get 103.68. This is first year. And we are looking at the end of first year. End of the years. Okay. So this is first year. Then we look at second year. Now what will be the opening balance in the second year? 103.68. Okay. Yeah. Can you tell me the amount of interest on this principal in the second year? Very simple. On this amount, we will compute interest, which comes out to 11.41. So this comes out to 11.41. And let's understand how this amount is computed. So what have I done? So I'm just giving this hash, and this is for next year, 103.68 into 11%. So what do we get? 11.41. Okay, yeah. Then next year, once again, what do? We will repay this amount and we will get the balance. So now this is what will continue for 6 years. So third year, fourth year, fifth year, up to 6th year, this will continue. And at the end of the 6th year, this amount will become 0. Yeah, this amount will become 0. All right. And you may have a question in your mind that, sir, interest rate is 12%. Then why we are considering the interest at 11%? I'm hoping that you remember this concept. If that is the question in your mind, I'm hoping that you remember the concept that this interest is not the market. And again, it's not necessary that the market rate of interest has to be higher than what is there in the contract. In this example, you can see it's lower than what is there in the contract. And there are reasons for this. Correct? Yeah. So even though the payouts, what are payouts? Repayments. Even though the repayments will be made as per the contractual interest rate, still for the purposes of our accounting, what is the interest that we will consider? For the purposes of accounting, in the first year, this will be the interest. In the second year, this will be the interest. Okay. This is how interest amounts will keep going. Okay. Yeah. Understood? Fine. And then I'm not just completing this I'm not completing this table. It's there in the study material. And I would suggest that all of you should just complete this table. Huh? So I'm not completing this table, but you should complete this table. I'm hoping that you are solving this completely. Yeah. You can also keep sharing your responses. I'm not getting any responses from you. I need your responses alongside. Okay. Now this was the second step. So now as a first step, we have identified host contract and the embedded derivative. In the second step, what have we done? We have computed the amortized cost. We have computed the amounts which need to be recognized in respect of host contract. For the host, we have computed all of these amounts. Correct? Yeah. Let's move on to step number 3. Let's move on to step number 3. Now we need to compare the exercise price of the prepayment option with the amortized cost of the host debt instrument. Okay. Now, if we look at all of these years, what has been the balance? This balance is what? Closing balance. In the second year, this was 103.09. Okay. Now what we will do is we will compare all of the closing balances of the host instrument with the payment option. So I'll have to just clear this working now. And I'll clear this part also. But I'll need these closing balances. So end of year 1, 2, 3, 4, 5, 6. So we have balance of host instrument. So this was 103.68, 103.09. Yeah, let's put down all of these numbers. 102.43. Fourth year, the amount is 101.70. Fifth year, amount is 100.90. And in the sixth year, the balance becomes 0. Correct? Yeah. Now I can clear this part also. And for the purposes of our reference, I'll just sort of put this in a tabular form so that it becomes easily readable. Now we need to put the value of the prepayment option. So this exercise price of prepayment option. What's the exercise price of prepayment option? 3% is the penalty amount. On what? Principal. Correct? So 103, 103, 103, 103, 103, but at the end of 6th year it will become nil. And let's understand why it is 103. So when you will prepay the loan, what will happen? You will pay the principal amount plus 3% penalty on the principal amount. Now you may have a question once again that, sir, even though repayment is happening every year, still the prepayment amount will not change. No, that is what bank has agreed with the customer. Okay, yeah. So let's understand the difference. Difference between these two. What's the difference percentage? Can you compute the difference percentage in both the cases? So in the first year, we have 103.68. What's the difference percentage? So this comes out to 0.67. This comes out to 0.67. So we are just considering the difference percentage over 103. So what I've computed is the difference between these two is 3.68. What's the percentage of this over 103? This comes out to 0.67, or we can just say 0.7%. In the second case, can you compute this? In the second case, can you compute this? Yes, I am also computing this. You should compute this and let me know. This comes out to 0.08. So we are considering this to be 0.1%. Yeah. In the third case, it's going down. In the third case, it's going down. So let's once again compute this. 102 minus 102.43. This is 0.57 is the change. Yeah. So this comes out to 0.6 minus 0.6%. Remaining amounts, you can just quickly compute and let me know. Then this is minus 1.3%. Then this is minus 2.1%, and this is nil. Okay, now we need to analyze. Now we need to analyze all of these differences. Yeah. Now, if you look at this entity PQR, they may formulate an appropriate accounting policy to determine what constitutes approximate equal. In this case, if the management determines that a difference of more than 2% will indicate that the options exercise price is not approximately equal to the amortized cost of the whole test instrument, it will need to separate the embedded derivative and account for it as per the principles given in the subsequent subsection, which we'll discuss. Okay. It may be questioned as to why an option to repay a fixed rate loan meets the definition of embedded derivative, for which we can just read this para once again. And I am on the study material, all of you. I am on this page number 12.137. Some or all of the cash flows that otherwise would be required by the contract to be modified. In the context of a fixed rate debt, it may be interpreted that option affects cash flows only if exercised, and the cash flows of a fixed rate debt do not vary with interest rates. However, in the context that we are discussing right now, a variation in cash flows should be interpreted as a possible change in fair value of expected cash flows. Accordingly, the option's expected cash flows vary according to interest rates in a similar way as a separate option to purchase a fixed rate debt asset at a fixed price. A fixed price option to prepay a fixed rate loan will increase in value as the interest rate declines, and vice versa. Now, in this case, we need to just go back to our understanding of this embedded derivative. Okay. Yeah. Now, in this case, a question will arise whether this prepayment option is an embedded derivative or not. I think we are clear on this, but still we'll have to substantiate this point. Secondly, when do we separate it and when do we not separate it? Now, this will be dependent on the accounting policy of the company. Company will have to formulate an accounting policy as suggested in the solution. Now, again, this is something which is suggested. So it's not necessary that you will always consider this to be 2%. You can always have this as 1.5% or 1% or 2.5% or 3%. This varies. But what is it that we have been trying to achieve by discussing this point of 2%? That when is this separation required to be done? And for this, we need to get on to the principles of separation, which we discussed yesterday. Yeah, all of you clear on this? All of you clear on this? If you have any questions, any doubts on this, please let me know. You are all clear on this? Clear? Any questions, any doubts in case you have on this? So I'm also just trying to get on to the relevant discussion. Yes, I think if you want, you can just read this para once again for the purposes of your understanding. This para, which is just below the table, the management of an entity may formulate an appropriate accounting policy. Yeah, that's the most important point over here. All right, clear? Okay, perfect. So Anjali is saying yes, sir. It's very clear. Very good. Now moving further, and I think we can pick up one more illustration. Very interesting one, I would say. Illustration number 6. So I'm just straight away jumping to this illustration without getting into the discussion related to this particular topic. This is again about the embedded derivatives, but we will come back to the understanding around this topic after solving this illustration. Okay. Yeah. On 1st of January 2000 X1, ABG Private Limited, a company incorporated in India, enters into a contract to buy solar panels from A&A Associates, a firm domiciled in UAE, for which delivery is due after 6 months. That is on 30th of June 2000 X1. June 2000 X1, and this is, they have entered into this contract on 1st of January 2000 X1. The purchase price for solar panels is USD $50 million. USD 50 million. Functional currency of ABG is INR, and of the supplier A&A is dirhams. For ABG, it's INR as the functional currency. Obligation to settle the contract in US dollars has been evaluated to be an embedded derivative, which is not closely related to the host purchase contract. I'll discuss this point separately with you. Exchange rates are given on 1st of January, on 30th June, exchange rates on 1st of January and 30th June, and 6 months forward rate is also given. That is equivalent to 65. Okay. Now in this case, a question may come to your mind, sir, what is the embedded derivative over here? Yeah. So let's understand, because by default it's been given. In the question it says, it's by default given that there is an embedded derivative in this. But we need to understand what is that embedded derivative. Correct? Okay. Now, there are two parties involved, ABG and A&A. ABG and A&A. These are the two parties, correct? ABG has functional currency as INR, and this has functional currency as dirhams. Now, this is very interesting, huh? So that's why I need your attention on this. This is not complex, but interesting. Now, if we generally enter into any contract with any party, so what do? We will generally enter into a contract with another party, either in our currency or the currency of the other party. That is what you will generally see. Yeah. Let's suppose there is a company in India. This company will sell the goods in INR, or if this company is selling goods, let's suppose in Europe, it may sell the goods in Euro. Selling the goods means entering into a contract. Let's suppose if Indian company is selling the goods in Japan, it may enter the contract in Japanese currency. Yeah. Or let's suppose if an Indian company is purchasing goods, say from UK, it may enter into the contract with UK either in INR or in UK currency. Whenever two parties enter into any contract, they would enter into such a contract in either of their currencies. That is how transactions are generally done. Yes or no? So if we follow the same thing, it's not a rule, it's not a mandate, but I'm saying this is what you see in practice. But in this case, if you look at both the parties, their functional currencies are INR and dirhams. And instead of having these currencies, which are also their local currency, see, functional currency of ABG is INR, and that is also the local currency because there is a company based in India, incorporated in India. Similarly, A&A is also a company in UAE. Instead of getting into either of these currencies, what have these two companies done? They have entered into a contract in USD. Let's understand the rationale, or let's think about it. Why could they do this? What would have been the reason for them to enter into such type of contract at in a currency different from their respective currencies? A thought which comes to my mind, I'm sure, which will also come to your mind, could be that, sir, are they not trying to hedge their risk in respect of the currencies in which they might be dealing with, or in which they may be transacting, or which may be their respective functional currencies? And then next question could be around how is that hedging possible? Let's suppose we think about ABG. ABG should have entered into this contract in dirham. But let's suppose ABG is worried about the exchange rate of dirham. ABG is expecting that dirham may fluctuate significantly. Why? Because there's a 6 months period for payment. And that's why, what has ABG tried to do? ABG has tried to hedge this risk. ABG has tried to cover this risk by entering into a contract in USD instead of dirham. And you may think that, sir, will the USD not fluctuate? Yes, it will fluctuate. But it could be that ABG was expecting dirham to fluctuate significantly, but so much fluctuation was not expected by ABG in USD. And that's why he may have entered into this contract in USD instead of dirham. Correct? So if you look at this type of transaction, what is it? Actually, this transaction has two components. What are the two components? One is purchase of, I think solar panels are getting purchased. Purchase of solar panels. Yeah, this is the first part or first component of the transaction. And what's been the second component? Second component is a foreign exchange forward contract. Is this any different from what you see in case of a forward contract? No. The same thing is done in case of a forward contract. In a way, these two parties have entered into a forward contract, which is what? Which is nothing but a hedging instrument, or you can say which is nothing but a derivative. Yes or no? Yeah. So now what do we need to understand? First of all, we need to understand whether these two components exist or not, which we have done. So now we have understood, yes, these two components exist in this transaction. Now what's the next step? Next step is to check what will be the host contract and what will be the embedded derivative. And then we need to subsequently check their accounting requirements. All right, clear on this? And I'm sure the question, or sorry, the answer of first question is already there in front of us. Yeah. So let's read this from the solution in the study material. Host contract to purchase solar panels denominated in INR. Ideally, the solar panel should have been purchased in INR. Yeah. So the purchase of solar panels in INR is what? That is nothing but a host contract. Yeah, which will involve notional payment in INR at 6 months forward rate. And what's the 6 months forward rate? If you look at the 6 months forward rate, it's 65. So what will be the amount? So amount will be 65 into 50 million. So if we compute 50 million, into 65, what do you get? We get 3.25 million. Sorry, 3250 million. So which is equivalent to 325 crores. Yeah. Yeah. Okay. Now, what's this next component? Forward contract. Forward contract to pay USD. Why we are saying to pay? Because in this case, ABG would be required to pay USD. So that's why when he would cover his risk, what would he say? He would pay USD and receive INR. He would pay USD and receive INR. That is notional receipt in INR. In other words, a forward contract to sell USD at INR 65 per USD. And why we are taking again 65? Because this is again the forward rate. You may have a question in mind that, sir, why we are saying that these purchases will be in INR? And why we are saying that the sale of USD will be in INR? It's all notional. Please understand, it's all notional. Notional means not actual. We are just getting into the substance of this arrangement. If you look at the arrangement, this was not structured the way we have tried to, sort of break it. It's structured in a completely different manner. It's structured the way it's written. But if you go to the substance of this arrangement, what do you get? You actually get to see two components over there. And that's why, because we are segregating it on the basis of their substance, so that's why some sort of notional element will come into the picture. Fine? Clear on this? Any questions if you have on these two components, please let me know. Because if you are clear on these two components, then the remaining part of the solution will become very easy. Because in all of these type of instruments, I would say the most complicated or the only challenging part which you would face would be about getting into these two components. Because if you get these two components, then I don't see any problem in terms of their accounting, because their accounting is something which we have been discussing for so many sessions now. Yes or no? Yeah. In the last example also, you would have seen that the accounting was so simple, computation was so simple, because we are very familiar with this. But something with which we are not very familiar is about breaking a particular instrument into components. When it has two components which are in the nature of host contract and embedded derivative. Clear? All of you? Clear on this? Yes, tell me quickly. Clear on this? No questions on this? Yeah? Okay. Now, if you look at this notional INR payment in respect of host contract and notional INR receipt in respect of embedded derivative, they create an offsetting position. Obviously, that is how this will be offset. Subsequently, host contract is not accounted for until delivery. Obviously, if you are considering this to be a host contract, so if we are saying this is host contract, when will this get accounted for? This will get accounted for on delivery. Yeah. The embedded derivative is recorded at fair value through P&L. We understand that embedded derivative the embedded derivative will be recorded at fair value through P&L. This is what we do always. This gives rise to a gain or loss on the derivative and a corresponding derivative asset or liability. Let's understand how. On delivery, ABG records the inventory at the amount of the host contract. The embedded derivative is considered to expire. The derivative asset or liability, that means the cumulative gain or loss, is settled by becoming part of financial liability that arises on delivery. Now in this case, the carrying value of currency forward on 30th June on maturity is INR 50 million into 66 minus 65, which is equivalent to INR 50 million. And why we are saying 66 minus 65? Let's understand. So what's the rate on 30th June? Sorry, 1 USD is equivalent to INR 66. That's the rate. That's the rate. Yeah. And what's the forward contract rate? So the forward contract says 1 USD is equivalent to INR 65. Yeah. Now, considering this, what will happen? On this date, settlement will happen at 66 million. So what is required to be paid? The amount that is required to be paid is 50 million USD. Amount that is required to be paid is 50 million. Yeah. So that's why what do? We will say the carrying value of the currency forward at 30th June on, that means maturity will be 50 million into forward rate, closing rate minus forward rate, because at forward rate it is already appearing. At forward rate it is already appearing. So we will take it to the closing balance or the closing rate. So the difference between these two, yeah, will be 50 million. The loss arises because ABG has agreed to sell USD at 65 per USD, whereas in the open market, USD can be sold at 66 per USD. No accounting entries are passed on the date of entering into purchase contract. On that date, forward contract has a fair value of 0, which we'll discuss separately why we are saying that is 0. Subsequently, at 30th June 2001, what are the accounting entries that we will require to pass? So the first, so I'm just putting down the accounting entries now. So what will be the first accounting entry? So in the first instance, we are saying this loss on derivative contract. What's the amount? It's 50 million or 5 crore. So we are seeing rupees in crores. Loss on derivative contract debit to derivative liability. Loss on currency forward contract, or you can say foreign currency forward contract. This was the loss. Why there was a loss? Because he will be able to sell the USD at 65 even though market rate is 66. So that's why there's a loss. Now what will happen? Now when he will be required to pay USD, he will be required to pay USD. So when he will be required to pay USD, at what amount he will pay? At what amount he will pay? He will pay at this amount, correct? But this liability which is appearing because of loss, that will also get reclassified to the trade payable. So the third entry will be closing of this derivative liability to trade payable 5 and 5. So it's the reclassification of derivative liability to the trade payables on the settlement date. Now what's the effect? The effect is that financial liability at the date of delivery is 325 plus 5 crore. It's increased to 330 crores, which is equivalent to 50 million USD settled at 66 per USD. And that is what will be required to be done. On 30th June, what will be required? On 30th June, ABG will be required to pay 50 million USD at the rate 66 per USD. So that means his total liability on 30th June should be what? 50 million into 66. Now, if you look at our accounting entries, our total liability also becomes equivalent to 330. That means 50 million into 66. So eventually what has been achieved? Eventually we have come down to the same number. But what has really been done by us is we have sort of included this accounting entry in our scheme of things. You may have a question that, sir, why we are getting into such a complicated accounting? Why we are doing this accounting? Can we not record it straight away that inventory debit to trade payable on the date of entering into this contract, or maybe on the date of purchase, and then paying it off at 66? We can do that. We can do that. There is absolutely no problem in doing that. But you need to understand that whenever you enter into any such type of contract wherein there is a sort of embedded derivative involved, then such an embedded derivative needs to be accounted for. And what's the accounting for an embedded derivative? The accounting for embedded derivative requires its fair valuation at every reporting date. Okay, and what's the reporting date in our case? A reporting date in our case is 30th June. So that's why on this date, we have computed the fair value of this embedded derivative, which has resulted in a loss of 5 crore. Yeah, clear? Clear? Clear on this? Any questions from your side? Any doubts if you have on this? Anjali is asking, sir, when will when we will account for this at the time of contract or delivery. We are doing this at the time of delivery. Anjali is asking, sir, why we have not passed the entries on the date of purchase. So if you again look at the second para, if you again look at the second para, can you go to the solution, please? See, it's the notional accounting that we have been doing. Host contract is not getting accounted for until delivery. Why? Because if you look at the normal accounting rules, then on 1st of January 2000 X1, you would have recorded a purchase transaction. You would have recorded a purchase transaction. But the way we have now segregated this is not something which you do for a normal purchase transaction. Now we are not considering this to be a normal purchase transaction. We are saying that this particular transaction has two components. One, that of purchase in INR. Second is of forward contract. Now, can you record purchase in INR on this date? No. When do you do that? On the date of settlement. So that's why host contract is not accounted for until delivery. The embedded derivative is recorded at fair value through P&L, which gives rise to a gain or loss on the derivative and a corresponding derivative asset or liability. Now, another point which becomes important for your references, that's it. Does it mean that on this date no accounting will be done? No. For this, you can go to page number 12.140, second para. No accounting entries are passed on the date of entering into the purchase contract. On that date, why? Why we are not doing that? This forward contract, okay, this forward contract, which has been considered to be an embedded derivative, has a fair valuation of 0. And again, you may have a question, sir, why would its fair valuation be 0? See, for your purposes, you don't need to get into the fair valuation. You don't need to get into the computation of fair valuation. That will be given to you in the question. What you need to understand here is that because the fair valuation is missing, because the fair valuation is nil, that's why, how can you record it? You don't have the value. So when you record an accounting entry, you need some value. On day one, that means on the date of entering into this contract, fair valuation of that forward contract is nil. Okay. And we will have discussion on this as to why it should generally be nil. Clear? Clear on this? Any more questions? Any more doubts in case you have on this? Yes, quickly. Yes, any questions from your side on this? No? No? All right, so then we can move on to next sort of embedded derivatives. Yeah, you can please refer to point number 4 on page number 12.140. 12.140. So we are now discussing about option and non-option based derivatives. And again, let's start with non-option based derivatives because this is easier to understand, and then we'll go on to option based derivatives. Non-option based derivatives. What do we mean by this concept? The terms of an embedded non-option derivative. So in the context of derivative, we are only talking about derivatives which will be embedded. Now, yeah. So the terms of an embedded non-option derivative, what are those? Forward, swap, must be determined so as to result in embedded derivative having a fair value of 0 at the inception of hybrid contract. Let's understand. This is host and this is embedded derivative. So we are saying option based and this is non-option based. If you remember, we discussed that derivative could be of two types. One, wherein one party will get the option which that party may or may not exercise. And the other type, wherein both the parties are bound to settle that contract. First situation will have an example of an option only. This is an example that we have discussed many times, and that is about option to buy the shares of another company. So there are two companies which enter into a contract which allow one company to buy shares of another company at a particular price. In this case, this is an option with one party. This party may or may not buy the shares. There is no foundation on this party to buy, and that's why this contract may get expired, even though it's not, and this may not get exercised. This may get expired without exercising this right by the party. Correct? Yeah. Another type of contract could be the one like we just discussed for foreign exchange forward contract, wherein both the parties will enter into a contract, and on the date of settlement, both the parties will have to necessarily settle the contract. Why? Because they are bound. None of the parties has an option. Both the parties are required to settle it. So the first one, wherein the option is involved, what do we call it as? Option based derivative, or we can call it as, if that is embedded somewhere, option based embedded derivative. The second one, wherein the option is not there, that is called as non-option based derivative or non-option based embedded derivative. Okay. Now, this means if you look at the forward means forward contract. If you look at the swap contract, what are those? These are those which are necessarily required to be settled. These cannot get exercised, these cannot get expired without exercising. Yes. So what do we call them as? Non-option based derivative. Okay. Now, with this understanding, let's get back to this para. 4a. Okay. Terms of an embedded non-option derivative such as forward, swap must be determined so as to result in the embedded derivative having a fair value of 0 at the inception of hybrid contract. Non-option based derivatives represent obligations of the counterparties to a contract. Fair value of a financial instrument is a combination of its intrinsic value and time value. In a fair and perfect market, it would be inappropriate to conclude that immediately at the inception of a contract, it results in creation of rights and obligations for two independent parties. That is, the contract has no intrinsic value at inception. Also, the time value starts accumulating only after the first day of the contract. The standard specifies that if it were permitted to separate embedded non-option based derivatives on other terms, a single hybrid contract could be decomposed into an infinite variety of combinations of host-debt instruments and embedded derivatives. For example, by separating embedded derivatives with terms that create leverage, symmetry, or some other risk exposure not already present in the hybrid contract. Therefore, it is inappropriate to separate an embedded non-option based derivative on terms that result in fair value other than 0 at the inception of hybrid contract. Further, in case of non-option based derivatives, terms of the host debt instrument reflect A, stated, or B, implied substantive terms of the hybrid contract. In the absence of implied or stated terms, entity makes its own judgment of the terms. So now all of this technical literature purposefully I have read for you, because as I have been telling you about derivatives, these are considered to be complex. So that's why in the exam, it is possible that you may be getting some of this literature in the form of any question or maybe in the form of any sort of assessment which will be required to be done. So that's why it's very, very important for you to go through some of this literature and then understand that even though the terminologies are different, the concept remains very simple. Something like this we just discussed. So if we call derivative to be option based or non-option based, we all know about this. So have you learned anything different over here? No. Now, coming back to what this is saying. So this is saying that non-option based derivative will always have fair value equal to nil at inception. It is saying the fair value of these type of derivatives should always be nil. And there is a reason for this. They are saying that how do you determine the fair value? Fair value should include two components. One, that is intrinsic value. Second, that is time value. Time value is built over a period of time. On day 0, time value will not be built. So if you have to build the time value, what do you need? You need time to go by. On this day, there is no time value which is involved. Correct? Yeah. So that's why if you look at the fair value, which should have two components, then time value is 0. By default, it is 0 on day 0. Next comes the point around intrinsic value. And you may have a question, sir, what is intrinsic value? Let's understand this conceptually. See, when two parties will enter into a contract, say A and B have entered into a contract. And now we are analyzing what's the fair value of this contract. Now, is it possible that these two parties will provide some benefit to another? No. Or in other words, can we say that on day 0, when these two parties will enter into a contract, wherein both these parties are independent, unrelated, then the contract may be biased in favor of one party? Never. Never. It has to be at arm's length, correct? It has to be as per the market norms. So it cannot be tilted in the favor of either of the parties. It has to be a balanced approach always. So that means on day zero, can we say that the contract will be providing some benefit to any of these parties, which could be, some benefit to one party, which would not be the which will not be equivalent to the benefit of the other party? No. So that means the intrinsic value, if that is considered, that means the value of benefit, that will be equal for both. And if that will be equal for both, that means its intrinsic value on day zero should be nil. Though once again, over the period, this contract may become beneficial for other party. Let's understand why. Say for example, when A and B entered into a contract on day zero, so A said that I will sell you USD. I'll sell you USD after 6 months at 65. Yeah. On this date, when A would agree with B, then A is trying to cover its risk, and B is also trying to cover up his risk by getting paid for this. Yeah. So that means on this date, both of them are balanced. But over the period, the situations may turn more in favor of A, or may turn more favorable for B or more favorable for A. Why? Because they would not know as to how the USD will behave over the period. So that is when the fair value of this type of instrument will get generated. Clear? Clear on this as to why the fair valuation of non-option based derivative should be nil. Clear on this? Yeah. Okay, Anjali has a question. Anjali is saying, sir, what if there are two reporting periods? How we will account for? Is it that until delivery will not pass? I think Anjali's query is in respect of the last illustration that we discussed. See, if there are two reporting periods, and that is again something like we discussed, that we will have to do the fair valuation of the derivative. So at the time of initial recognition, its value was nil, but which will not be the case at every reporting date. So that is something which will have to be analyzed. All right. And I'm hoping with this discussion, you must be getting more clarity now, because your question I think was prior to this discussion. All right. Yeah. So let's move on to point number B now. So let's move on to 4B. Which is about option-based derivatives. Let's quickly read this part. The economic behavior of a hybrid contract with an option-based derivative depends critically on the strike price, which is also called as exercise price, specified for the option feature. Therefore, separation of option-based derivative, which could be in the form of embedded put, call, cap, floor, caption, floortion, or swaption, should be based on stated terms of the option feature documented in the hybrid contract, unlike non-option based derivative, which is separated on the basis of implied terms also. As a result, embedded derivative would not necessarily have a fair value or intrinsic value equal to zero at the initial recognition. So that means this sort of situation is not necessary for option-based derivative. If an entity were required to identify terms of embedded option-based derivatives so as to achieve fair value of embedded derivative of zero, strike price generally would have to be determined so as to result in option being then definitely out of the money. this would imply zero probability of the option feature being exercised. Okay, so I'll just skip some of this theory part and I'll now move on to accounting for embedded derivatives. That's the next page, 5.2.2.3. So let's find out. The initial carrying amount of the host instrument is the residual amount after separating the embedded derivative. If a contract contains one or more embedded derivatives and the host is not a financial asset, an entity may designate entire hybrid contract as fair value through P&L. This is something that we have already discussed, correct? And then I think we have a nice flowchart available, which we should refer. So I think we should now move on straight away to this flowchart to get the complete understanding. One point, sorry, 12.143. Let's get on to this flowchart. Huh? Okay, so this flowchart begins with the hybrid contract. So we need to check, is the hybrid contract designated at fair value through P&L in its entirety? Yeah, if that is the case, then we don't separate embedded derivatives. And entire hybrid instrument is accounted for at fair value through P&L. If you go back to the flowchart that we discussed yesterday, for the time being, yeah, I'm just slightly digressing from this because it's very important again to establish the correlation. So if you can go to the flowchart on page number 12.14, sorry, page number 12.134. This part we discussed yesterday also. Can you quickly flip through this flowchart on 12.134, the one which we discussed yesterday? Some of the things that we are discussing on flowchart on this page are similar to, or you can say are in continuation of what we discussed on this flowchart. Okay, yeah, clear? Can you just quickly flip through this? You'll get more clarity of the concept if you do that. Yeah, done? All right. So then I'm going to this last flowchart once again. Sorry, flowchart on the last page. Now, in case the hybrid contract is not designated at fair value through P&L, then what do? We need to check, can the fair value of embedded derivative be measured reliably? If yes, measure the embedded derivative and allocate residual to host. So what does it mean? There's an approach which is called as residual approach, and which is very easy to understand. We have a hybrid instrument, correct, for which there will be some valuation, and this hybrid instrument will have two components, embedded derivative and host contract. So what is the standard saying? Standard is saying, how do you measure all of them? How do you measure this? How do you measure this? How do you measure this? Means in case you are required to measure this in a combined manner, how do you measure this? In case you need to separate them, how do you measure both of them? So I'm talking only about the measurement. Recognition is something that we have discussed now. So I'm not getting into the recognition, only the measurement. In this case, standard says, first of all, we should compute fair valuation of embedded derivative. This is the first step. We should compute fair valuation of embedded derivative. And fair value of hybrid minus fair value of embedded derivative. Fair value of hybrid instrument minus fair value of embedded derivative will be the value of the host contract. That is how we will measure the host contract. This is how we will measure the host contract. Can you relate one of the points that we have discussed under financial instruments only with this residual approach? Can you tell me what is that other place for measurement which has been considered by us under financial instruments? Yes, quickly. Can you just again correlate this point with some other topic wherein we have followed residual approach only? Under financial instruments only. Yeah, quickly. Let me just see if you can just establish that correlation or not. All of you, quickly, huh? Quickly, can you just tell me quickly, where do we establish that correlation? Anjali is saying fair value through P&L. No, so you need to tell me under financial instruments, which was that topic wherein we have applied residual approach. So I think Anjali is saying, sir, in case of financial assets to be measured at fair value through P&L, we discussed about residual approach. No. That was for classification. I am talking about measurement. For measurement, we have followed this residual approach. And I'm sure you would know this. Pujita is saying that was for compound financial instruments, sir. Very good. Very good. So now, in case of compound financial instruments, if you remember, what do we say? That whenever there is a compound financial instruments which will be broken into financial liability and equity, what do we do there? First of all, we compute the value of financial liability. And from the total value of compound, we reduce the value of financial liability. So that's why this becomes residual. This is the fundamental which needs to be applied everywhere. Yeah, very good. Okay, now the same type of approach is being considered over here. We are saying compute the value of hybrid, compute the fair value of embedded derivative first, and then this will become residual. So this is the priority. This is how we should go about it. Okay. Now, in case the fair value of embedded derivative cannot be measured reliably, then we need to check, is the entity not able to measure the fair value of the hybrid contract? If we say yes, then we need to check, is the entity able to measure fair value of the host contract? If we say yes, then what will happen? Then it will be other way around. Fair value of embedded derivative will be fair value of hybrid minus fair value of host. So this is, you can say we need to move in this sequence. So this is preference 1. If for some reason this fair value is not measurable, then what do we do? Then we will have this fair valuation and we need to check, can we get the fair value of the host? If yes, then what will happen? This will become fair value of hybrid minus fair value of host. Now this is something which we did not discuss in case of compound financial instrument. In case of compound financial instrument, we don't have any option but to follow this always. But in case of embedded derivatives, what do we need to do? Our preference should be to check fair value of embedded derivative. Even if we are able to get the fair value of host, still will not compute it. This should be residual. But in case fair value of embedded derivative is not available, then we will check if this fair valuation is available, and we will say fair valuation of embedded derivative is residual. That's why I'm saying preference 1 and then 2. Clear? If we say that entity is not able to measure fair value of hybrid contract, then what do? Entire hybrid contract is measured at fair value through P&L. Okay, clear? Yeah. That means without separation. All right, clear on this? So with this, we are done with our discussion on the embedded derivatives, and we can now pick up some questions to practice this. Yeah, so any of the questions we can pick up. Let me just find some questions for you. Yes, any questions from your side? No? Okay, Guru Raja is also. Okay, I think Guru Raja's response has come just now. He was also talking about the same point. Okay, yeah. So with this, we are done with our discussion on the embedded derivative. Now what we can do is we can get on to some questions. Okay, and I think we can pick up this illustration number 5. But I think this illustration will take some time. So what we can do is we can now take a break of 10 minutes. But before the break, you should just note this question. So this is page number, because if any of you would not like to go for a break, you can just start practicing this question. 1.175. 1.175. Illustration number 5. Yeah, you all can start solving this illustration. If you don't want to go in for a break now, it will be good to practice. But if you are going for the break, then immediately you are back. You should start solving this question, huh? Okay, all of you. And in the meantime, if you have any questions, any doubts, please let me know before we break. No? Okay, so let's take a break for 10 minutes. After the break, we will start with this illustration. All right? Yeah. Jay, Jay, Jay. Hi, welcome back. So we can now start with this illustration number 5. Yeah, I'm not sure whether you have attempted this or not, but you should start on this now, please. Yeah, on your own. It's very, very important that you practice this on your own. So let's move on to this illustration. On 1st of January 2000 X1, SAM Company Limited entered into a written put option for USD 20,000 with JT Corporation to be settled in future on 31st of December 2000 X1. So what's the arrangement? On 1st of January 2000 X1, company entered into a written put option for USD 20,000. This needs to be settled on 31st of December. That means after 1 year. Okay. For a rate equal to rupees 68 per USD at the option of JT Corporation. Who is the option? JT Corporation. SAM Company Limited did not receive any amount upon entering into the contract. SAM Company Limited is a listed company in India and prepares its financial statements on quarterly basis. Following the classification principles of recognition and measurement as laid down in Ind AS 109, you are required to record the entries for each quarter ended till the date of actual purchase of USD. That means up to 31st December 2000 X1. For the purposes of accounting, please use the following information representing mark-to-market fair value of put option contracts at each reporting date. So there are quarters in between. 31st March, 30th June, 30th September. So on each of these dates, fair value of put option contract is given to us. Spot rate of USD on 31st of December. So this is the rate for settlement. Spot rate is 66 INR. Okay. Yeah. Can you just start solving this on your own, all of you? Quickly, can you start solving this on your own, all of you? I will also start after a gap of 1 or 2 minutes. I'll just take a pause of 1 or 2 minutes so that you can just start and then I'll start on this. Some of you may be thinking that, sir, we are not able to understand many such points which are related to derivatives that we have just discussed. So therein I'll just tell you that whatever comes to your mind now, just think about it. And on the basis of thoughts that come to your mind, just try to solve it. Even if it goes wrong, it doesn't matter. Just try to attempt this once. Just try to attend this once. That is the most important part. Okay. Yeah. So I am now moving on to the solution. Assessment of the arrangement using the definition of derivative. First of all, so what are the three requirements for derivative? Underlying should be there, no initial investment or little investment. Third is settlement at a future date. Correct? Let's apply all of these conditions. The value of a contract to purchase USD at a fixed price changes in response to changes in foreign exchange rate. So what's the underlying? Forex is the underlying. Second, initial amount received to enter into the contract is zero. There is no investment, which is important and which has been specifically given in the question. A contract which would give the holder a similar response to foreign exchange rate changes would have required an investment of USD 20,000 on inception. But this is not the case. In this case, SAM Company Limited did not receive anything. Correct? Third, will it be settled at a future date? Yes. So what do we say? That this is definitely a derivative. So the return put option is a derivative as per Ind AS 109. Correct? Clear? Okay. Now, as per Ind AS 109, what do we say? Derivatives are measured at fair value upon recognition and are subsequently also measured at fair value, and the changes in fair value will keep going to P&L. So this will be measured at fair value, this will be measured at fair value, fair value, fair value, yeah, fair value. And the changes in the fair valuation will keep going to P&L. Every time there will be a change in fair valuation, it will go to P&L. Correct? Yeah? Okay. So let's begin with 1st January 2000 X1. As there was no consideration paid and without evidence to the contrary, fair value of the contract on the date of inception will be considered to be zero, as we discussed. Accordingly, no accounting entry will be passed. So on this date, what do? We will say fair valuation is nil. So what about accounting entry? None. Obviously, yeah. So then, where do we go? We go to the next reporting date, 31st March. On 31st March, what do we need to do? We need to record this at fair value. And fair value again, very simply is given to us in the question. What's the fair value of this written put option? 25,000. 25,000. Correct? The value of derivative put option shall be recorded as a derivative financial liability in the books by recording the following journal entry. So what's the journal entry? So on this date. So now this was the accounting entry on this date, on this date. So I'm not putting the dates, I'm not putting the dates, I'm just putting the accounting entry. P&L debit to derivative liability, 25,000, 25,000. And why we are recording this at 25,000? Because this is the fair value on which we need to record this. Correct? Yeah. Okay. Now, what's the next step? Next step is from 31st March, we'll move to 30th June. Okay, before that, if you want, you can also note down one point. On this date, 31st March, the fair value came out to be 25,000. And in the previous reporting period, fair value was 0. So what was the change in fair value? 25,000. And we know that any change in the fair value goes to P&L. So this went to P&L. Clear? Yeah. So we are in a way truing up the liability every time we recorded at reporting date. So now on the next date, that means 30th June, its fair valuation has become 15,000. Its fair valuation has become 15,000. So what's the change? So now this has become 15,000. So the change is negative. Sorry, the change is negative 10,000. Correct? Because on this date, this has become 15,000. So that's why the change is what? Negative 10,000. Now, if this is negative 10,000, what do we need to do? Derivative liability should now be reduced. Derivative liability will now be debited to P&L. 10,000, 10,000. So on, sorry, now I think I'll have to put the date. On 30th June, what will happen? The balance of this derivative liability will become 15,000. Correct? Simple. Again, on 30th September, let's see what's the fair valuation. On 30th September, its fair valuation again has become nil. Very good. And you may have questions, sir, why it is becoming nil? It doesn't matter to us. For us, we'll go by the valuation which is given in the question. So that means, once again, there is a change, and the change is equivalent to negative 15,000. So on 30th September, what do we do? We'll say derivative liability debited 15,000 to P&L. 15,000. Okay, yeah. 15,000, correct? And then settlement date has come. 31st of December. Settlement date has come 31st of December. So what do we do? On the settlement date, this contract will be settled. Either this will be expired without settlement, or this will be exercised by the party. In both the cases, this will be considered to be settled, whether exercised or not. The settlement of this derivative contract by actual purchase of USD 20,000 shall be recorded in the books of SAM Company Limited upon exercise by JT Corporation by recording the following journal entry. So what do we do? In the books of SAM Company Limited, I think I'll have to clear this part now. On 31st of December, what do we do? USD, which has been sort of purchased, will result in cash. Yeah. And this cash will come to SAM Company Limited equivalent to 20,000 USD into 66 per USD. So what's the amount? So the amount is 13,20,000. And against this, what will happen? USD will go out to cash 20,000 at the rate 68 will go out, because that's the option available with JT, which has been exercised by them, and that's why SAM company will have to honor this. So this will become 20,000 into 68, 13,60,000. Okay, yeah. And why is this required to be done? Because it's settled in gross. And the forward contract rate was 68. So at what rate this will have to be paid? This will have to be paid at 68. And any resultant change or the difference, where will it go? It will go to P&L. So that's the difference. You can say it's also the balancing figure. This will go to P&L. All right. Clear? Simple to do. Yes or no? You may be thinking, sir, this was so simple. And we were, after reading the illustration, thinking that it's very complex. How do we start? Where do we go? See, this is what happens in case of derivatives or embedded derivatives. When you read the question, when you read the language, this language may appear to be tough. But just look at the solution. Can you have anything simpler than this in your entire subject? No, you may be saying, so these are so simple accounting entries. And every information is available in the question. Yes. It's just that you need to practice some of these points. The more and more you practice, the better and better you will become. Yeah. And for following this principle, I can give you some homework now. You should practice illustration number 3 and 4. This is page number 12.170. So I'll just clear this part. Your homework, page number 12170, illustration 3 and 4. Okay, yeah, this is your homework, please. Just practice this on your own. Don't get into the solution. Just try to solve this on your own. Don't get into the solution till the time you have solved this on your own fully. Even if your solution goes wrong, as I told you, it doesn't matter. Important thing is that you need to attempt this. You need to practice this. Okay, yeah. So with this, we are done with our derivatives, embedded derivatives, all of these things. And now we will move on to the derecognition principles. So far, what have we discussed? We have discussed about definition of financial instrument, financial asset, financial liability, equity. Then we discussed about their classification. Then we discussed about their meanings in more detail. Means we evaluated them in more detail. How will an instrument become financial liability or equity? And alongside, we also discussed about their recognition requirements. And for all of these items, we also got into, other than these items, there was another financial instrument which could be derivative or which could be embedded in any contract. That part also we understood. We understood its recognition. We understood its measurement. So far we have discussed all of the things in terms of their recognition and measurement. Okay. Now we will start getting into the discussions related to derecognition. How do we derecognize any financial asset or any financial liability? Okay, yeah. So these derecognition principles are covered under Ind AS 109. So we are now getting into derecognition of all of these items. All right, clear? If you remember, when we were discussing about debt versus equity under Ind AS 32, there were certain things in relation to financial liability which we discussed in the context of derecognition also. If you remember, when a liability gets swapped with equity, there was also one appendix that we discussed, that when a liability gets extinguished, how do we record it? Those were the principles of derecognition, which we have covered, but those were small points related to derecognition. That is also something which should have fallen under this discussion that we are starting now. So what we will do is, after we are done with our discussion on derecognition, we will touch upon those aspects as well, so that you can just completely put that at one place. Okay, clear? So now I'm beginning with derecognition of financial assets. And for this understanding of derecognition of financial assets, once again, we have a nice chart available in the study material, with the help of which this derecognition becomes very simple to understand. I would request all of you to open that, get onto this page number 12.107. All of you. Can you go to this page number 12.107? Yeah? So we are starting with derecognition of financial assets. Financial assets, you all know what are financial assets. Yes. So about those financial assets, we have discussed when we recognize them. They may be recognized at amortized cost or fair value through P&L or fair value through OCI. Now, these financial assets may be required to be derecognized. Derecognition means they may be required to be taken off the books of accounts. And once again, you may think, sir, but how do we derecognize them? It's very simple. For example, if we talk about lease deposits, which we discussed. So when the lease deposit money will be collected, when we collect cash, that is when we derecognize it. Is it not simple like that? Yes, it's correct. It's correct. So when you are collecting the money against the lease deposits, or maybe against the loans which are given, what do? You will derecognize them. Yeah. Or maybe when you sell the loan, maybe when you sell the loan, you will derecognize them. Correct? So these are all, again, the same sort of transactions which will fall under derecognition of financial assets. But derecognition has something more than this. Let's understand what is that something more than this. I'm hoping that you would have noted down the homework. So I'm just clearing this part. Let's suppose if we talk about trade receivables, or maybe an entity which has given a loan. Okay, some of the entities maintain a portfolio of loans, something which we discussed in case of business model also. Yeah. Now, it is not necessary that these entities will wait till the end of maturity period. Let's suppose trade receivables will be collected after 3 months. Okay. Now, at times, it is possible that, say, after 2 months, the company got this these trade receivables discounted from the bank. Discounting means these are sold to a banker. Sold to a bank or a financial institution. Now, what does this sale mean? Many of you would know this, but still, let's understand what do we mean by this sale of trade receivables or discounting of trade receivables or the sale of loans. This discounting is not about computing the present value. This discounting is something which is in the nature of sale. In this case, two options, or you can say two types of transactions are possible. Say A Limited has got trade receivables, but A Limited needs money before 3 months. So A Limited reached out to a bank and sold its trade receivables to the bank, which means on the due date, money from the trade receivables will be collected by the bank. So today bank has given money to A Limited after deducting some amount, which will be charges, which bank will charge, because that is how bank will earn. And after 3 months, who will collect the money? Bank. And the risk of this collection of trade receivables also lies with the bank. Let's suppose if there's any default on the collection of trade receivables, say that debtor refuses to pay, then who will bear the risk? Bank will bear the risk. So this is one type of transaction, which is rare. Bank will generally not bear this type of risk, because otherwise, what will be the benefit of the bank? Bank will lose out significantly. Correct. Another transaction which is possible is that after 3 months, bank will collect this money from the trade receivable debtor, or after 3 months, A Limited will collect the money from the debtor and pay to the bank, because this will be collected on behalf of the bank, because this trade receiver belongs to the bank. And if there is any default on the due date, then who will bear the risk? A Limited. Okay, yeah. Now, as a part of our discussion of derecognition of financial assets, this is something which we are going to focus on. Because other than this, if we talk about collection of trade receivables, collection of loans, all of these things are normal deregulations, which will automatically happen at the time of settlement. But these are the specific transactions which we need to understand, that if this discounting is done, if the trade receivables are sold like this, then do we derecognize them in the books of A Limited or not? And again, you may think, sir, how can you say or not? If they are selling the trade receivable, they should do this, they must do this. Not necessarily. And that is what we will understand with the help of this flowchart. Okay. Yeah. Understanding of this complete flowchart will be important, because there are many points which are interlinked in this flowchart. Okay. Yeah. Clear? So whenever you revise it later on, please remember that you will have to just ensure that you go through this complete flowchart, because there are a lot of points which are interlinked here. Yeah, clear? Okay, so let's begin with the first step. First step says consolidate all subsidiaries. And the way these points are given in the flowchart is that for each and every point, or you can say for each and every step, we have certain situations available for the purposes of our understanding, means some examples are available or some notes are available. So what we will do is every time we'll look into a step or a point, we will get into the notes. That is how we will approach this complete topic. Okay. Now comes the point around consolidation of all subsidiaries. So why, sir, you may think, sir, why do we need to consolidate all the subsidiaries? What's the relevance of consolidation of all subsidiaries? Can this not be done for the standalone financial statements? It can be done. There's no doubt about it. But let's understand, why do we need to consolidate all the subsidiaries? So let's go to note number 1 first. In the consolidated financial statements, accounting principles for derecognition are applied at a consolidated level. That's the point. They are saying when you look at the consolidated financial statements, then apply derecognition principles at console level. Means by looking at the number which are consolidated for the group as a whole. Hence, an entity first consolidates its subsidiaries. The importance is that sometimes sales of financial assets are made to entities which are specifically designed for this purpose. In those circumstances, it would be inappropriate to derecognize the financial asset if the purchaser entity is indirectly controlled by the seller entity. Let's suppose A Limited has sold financial assets to its subsidiary, or say to group company. To any of its group company. Yeah. Now, in case if we derecognize this financial asset in the books of A Limited and which also happen to be the consolidated financial statements, will that be appropriate? Because this asset is sitting over there. This asset is sitting over there means in the group's financial statements, in the consolidated financial statements. That's why what should be the first step? First step should be to console both of them. When this consolidation will happen, what will happen? Automatically these transactions will be knocked off. Okay. Then we should apply the derecognition principles. Yeah. Then I think the important point with which we need to start happens to be point number 2. So let's go back to the flow chart. Now, what's the next step? Next step. Point number 2. Determine whether the derecognition principles are applied to part or all of the asset. So let's understand what do we mean by part or all of the asset. Means should we apply the derecognition principle to the complete financial asset or only a part of it? So again, we'll have to look at some examples to understand this. So for this, once again, I'm taking you to note number 2, on which we have some illustrations which will give us an understanding about meaning of part of an asset. So you again may think, sir, why would we derecognize only a part? We should derecognize complete asset. It's not always. Let's understand this. Let's go to illustration number 4 on page number 12.108. Okay. State whether the derecognition principles will be applied or not. So we need to confirm. First, interest strip of an interest bearing financial asset, that is, the part entitles its holder to interest cash flows of a financial asset. So let's understand this one. In this part, the cash flows for the part is specifically identified. For example, when an entity enters into an interest rate strip whereby the counterparty obtains the right to interest but not the principal from a debt instrument, derecognition principles are applied to only the interest cash flows. say A Limited has given a loan given to B Limited, say 100 crores. Okay, yeah, it has given a loan to B Limited for 100 crores. And this is B Limited. So what are we trying to say here? We are saying that currently A Limited is entitled to two things. What are those two things? Principal and interest. Now what A Limited has done? A Limited has entered into a contract with a bank. And A Limited has sold its rights towards this interest. To the bank. A Limited has sold its rights towards interest to the bank. But the rights towards the principal continue to remain with A Limited. So what will happen? Every time the interest will be collected, who will get the interest? Bank. But when the principal will be collected, who will get the principal? It will go to A Limited only. This is called as part sale of a financial asset. So what's the full sale of the financial asset? That this complete loan is sold to the bank, or all the rights for principal as well as interest are transferred to the bank. But if only one portion is transferred to the bank, what do we say? It's a part. Now, can we consider this part sale? Can we consider this part derecognition? Because when A would have recognized this financial asset, A would have recognized two components of financial assets in its books. Of course, yes. Yeah. Because how would A Limited recognize loan given at present value of cash inflows, present value of principal and present value of interest? Correct? So now when A Limited will derecognize, what will it do? It will derecognize present value of interest, but not the present value of principal. Clear? Clear on this meaning? Yeah. Let's look at another example. Dividend strip of an equity share, that is, part entitles its holder to only dividends. Holder means bank, the party which is getting the right to that particular cash flow. The part entitles its holder to only dividends arising from an equity share. Okay. The part comprises only a fully proportionate pro rata share of the cash flows from a financial asset. For example, when an entity enters into an arrangement whereby the counterparty obtains right to 90% share of the cash flows of a debt instrument, derecognition principles are applied to 90% of those cash flows. Okay, clear? Now considering this, the example of a part of financial asset at third. So third we are ignoring. Yeah. Or let's just read all of these points. Cash flows, principal and interest up to a certain tenure or first right on a proportion of cash flows of an amortized financial asset. See, the part entitles its holder to first 80% of the cash flows or cash flows for the first 4 of the 6 years times. Means in the third situation, what are we saying? That cash flows will come for 6 years. 1, 2, 3, 4, 5, 6. For the first 4 years, the cash flows will go to the holder. The cash flows will go to the holder, and for the remaining 2 years, the cash flows will remain with the company. So this is the holder, this is the company. Okay. So these are the three arrangements. And what are the principles that we are discussing? So we are saying derecognition principles are applied to part of financial asset if that part meets any of the following three conditions. Two we have discussed. Third, the part comprises only a fully proportionate share of specifically identified cash flows from a financial asset. For example, when an entity enters into an arrangement whereby counterparty obtains 90% share of interest cash flows from a financial asset. So the example of a part of financial asset at third means this third situation will not qualify the conditions at B and C since it does not represent pro rata share of all or specifically identified cash flows. In B and C above, if there is more than one counterparty, each counterparty is not required to have proportionate share of the cash flows, provided that transferring entry has a fully proportionate share. In all other cases, that means in situation number 1, cases means in first and in second. In first and in second, derecognition principles are applied to financial asset in its entirety or to the group of similar financial assets in their entirety. Okay. Yeah. Let's move to illustration number 5 now. State whether the derecognition principles will be applied or not in this example. Entity Y transfers the right to first or the last 90% of cash collections from a financial asset. Entity Z transfers the rights to 90% of the cash flows from a group of receivables, but provides a guarantee to compensate the buyer for any credit losses up to 8% of the principal amount of receivables. Now, in this case, let's understand what can be the problem. So the first one, let me just put it in the form of a chart. Entity Y transfers the rights to first. So let's suppose these are the cash flows or last 90% of the cash collections from a financial asset. So let's suppose these are the cash collections. So entity Y will get these cash flows. Yeah, currently that's the financial asset with entity Y. Y has a financial asset. And Y is transferring this to another party, say to a bank. For the purposes of our discussion, we are keeping bank as another party. And what is entity Y saying? That it will transfer first or last 90%. It will transfer first 90% of the cash flows or last 90% of the cash flows. Can we say in this case, we have specifically identified cash flows which will go to the bank? No, it's not clear. Because it can be first 90% or last 90%. So there's no clarity in this case. Let me just move on to second situation also, and then we will conclude. What should we do in this case? Entity Z transfers the rights to 90% of the cash flows from the group of receivables. Once again, we have similar sort of situation. and these assets are held by Z. Z is also selling this to a bank. Okay, Z is also selling this to a bank. Entity Z transfers right to 90% of the cash flows from a group of receivables, but provides a guarantee to compensate the buyer. Who's the buyer? Bank is the buyer. For any credit losses up to 8% of the principal amount of receivables. So it has transferred 90%. Now this 90% can be this. There is no identified 90%. This 90% can be this. Okay. Or maybe, yeah, or maybe some part of this is left and some part of this is left. This could be the 90%. So it's not clearly identified what is that 90%, number one. Number two, Z is also giving a guarantee to the bank that tomorrow, if there is any default in collection from these receivables, then up to 8% only, it says credit losses up to 8% of the principal amount will be borne by Z. Now, therein again, we are not sure about the cash flows. Can we say we have specifically identified cash flows in this case, which are getting transferred to the another party, the holder? No. So in this case, will the part sale be possible? Maybe they enter into a contract for a part sale, but when the derecognition of financial asset will happen, part derecognition will not be possible. It will have to be derecognized in its entirety. Clear? It will have to be derecognized in its entirety. Means the full financial asset will have to be derecognized in this case. Okay? Clear? All of you? Yeah? So are you now clear about this second step, which requires derecognition to be applied either on full asset or on part of the asset? So it's again not dependent on the terms. We need to analyze it like this. Yeah? Any questions, any doubts in case you have, please let me know. In case you have any questions, any doubts, I'll just wait for your questions now, quickly. If you have any questions, please let me know. Yes, any questions, any doubts in case you have on this? So today I have received very few queries from your side. I'm just hoping that you're finding the things easy to absorb. I can understand that these topics are not so simple the way you would have found other topics to be like, but definitely these are new, and that's why I would say these also become interesting for us. Yes, any questions, any doubts? Are you all with me? I'm hoping that you are able to appreciate. Yeah? Yes, quickly. Any questions, any doubts in case you have, please let me know. Any questions? No? So should we move? Yeah. Okay, so let's move on to the third step now. Now we need to check, have the rights to the cash flows from the asset expired? Means no right is left, rights have expired. If we say yes, that the rights have expired, then what do? We will de-recognize the asset. In case we say no, rights have not expired, still it may be de-recognized, but we need to check some more things in such a case. Okay. Now, how do we check that the rights have expired or not? For this, once again, we should follow the same approach of going to point number 3. Yeah. Okay. Cash flows from financial asset expire upon payment of entire due amount. Obviously. So let's suppose you have given a loan, you have received back. So what has happened? Cash flow is done. So you have received the money, rights have expired. So what do? You will de-recognize the asset. Okay. We discussed below few circumstances wherein renegotiation does not result in expiry of right to receive cash flows. Many a times, two parties, means one which is a holder, means which is holding the financial asset, enters into some different terms and conditions, or they start renegotiating the term. For example, say it's about a loan. Say it's about a loan. Say A has given a loan, or sorry, let's suppose say bank has given a loan to A Limited. Now for bank, it's a financial asset. Now we are checking whether some of these terms will result in derecognition of this financial asset for the bank. At times, it may happen that A Limited is unable to repay this amount. Maybe there is a default on EMIs. Yeah, could be for any reason. In such a case, what will the bank do? Bank will renegotiate the terms with A Limited. Bank will say, okay, let's take a moratorium period. After that, you can start paying, but at an increased amount, means at increased rate. Or maybe the bank may reduce the rates, but may increase the period, so that bank can earn more interest over the period. Or maybe the bank may agree to convert the loan or a part of the loan into equity shares. Yeah, that is how negotiations may happen. Some of these circumstances, even if they exist, they will not result in derecognition of financial assets. Because financial asset still continues to be there. It's just that the terms have been renegotiated. Okay, clear? Yeah. So let's move on to the flow chart once again. Please go back to the flow chart once again. Okay. Now we were saying, have the rights to the cash flows expired? If we say no, then what do we need to check? Has the entity transferred its right to receive cash flows? So one is the right has expired. If the right has not expired, then we need to check, has the entity transferred the right? If we say yes, then we will check some more points. If we say no, then we need to check, has the entity assumed, if the entity has not transferred the right, has the entity assumed contractual obligation to pay the cash flows in an arrangement that meets 3 conditions. Okay. But this next step is something on which we'll focus later on. First of all, we should now get on to this transfer of right, for which once again we'll go to note number 4. Let's look at some examples of transfers of rights. Now, this could be in the form of sale of financial assets, such as an investment in a debenture or assignment of a receivable like factoring. Okay, you go and get it discounted from the bank. So this is what? Transfer of a right. This is also called as factoring. So the discounting of trade receivable is also called as factoring arrangement. Okay, and it's not necessarily with a bank. This may be with any financial institution. Okay, yeah. We have some detailed illustrations also on this, on which we'll go later. For the time being, we are just understanding the steps which are involved. Okay, yeah. Now let's go back to the flow chart. Now we are saying that no, the entity has not transferred the right to receive cash flows. So the right is not transferred. Then even in that situation, derecognition is possible. So we need to check more. So what do we check? Has the entity assumed, means entity has taken a contractual obligation to pay cash in an arrangement that meets three conditions. So what are those three conditions? We'll talk about that later. So we are saying that there's a bank which has given a loan to A Limited, and this loan is nothing but a financial asset. Now the cash flows of the financial assets are with the bank only, but bank has also assumed an obligation, means taken an obligation through which bank will be required to pay these cash flows to some other party. If that is the case, then we need to check something more. If we say no, the bank has not assumed any such obligation, so do we need to derecognize the asset? No. So we continue to recognize the asset. If we say yes, then what do? Then we will check, has the entity transferred substantially all risks and rewards? Now we are not talking about transferring the rights. In case the entity would have transferred the right, then the entity will check this condition of transfer of substantially all risk and rewards. In case the entity has not transferred the right but assumed an obligation, something which we discussed, therein again entity will check. That means in both these scenarios, entity will check this condition. Has the entity transferred substantially all risk and rewards? If we say yes, then the entity will derecognize the asset. If no, then entity will check more. Now let's understand about transferring substantially all risk and rewards. What do we mean by this? Now, where do you see that? Where do you see that? Yeah. Now, in this case, when you look at transferring substantially all risk and rewards, you need to understand that it's substantially all. It's not 100%. Now, what is this substantially all? This has not been defined. This is more of judgmental. Now, what can be a substantial thing? Maybe 80%, 90%, 95%. It's all judgmental, which has to be analyzed on a case-to-case basis. Okay. So what we can do is we can now go to note number 6 once again, similar to that. Okay. Let's go to note number 6. Let's go to note number 6. There are few examples. Can you just start reading this? Yes. An unconditional sale of financial asset. A sale of financial asset together with an option to repurchase the financial asset at its fair value at the time of repurchase, and a sale of financial asset together with a put or call option that is deeply out of the money, that is option that is so far out of the money it is highly unlikely to go into the money before expiry. So what are we seeing here? that when we unconditionally sell the financial asset, that is nothing but a transfer of substantial risks and rewards. Okay, yeah. Some more examples wherein we can just look at these points A, B, C, D, E. A sale and repurchase transaction where the repurchase price is fixed price or sale price plus a lender's return is given. A securities lending arrangement, a sale of financial asset together with total return swap, a sale of financial asset, a sale of short-term receivables. Now, if you look at all of these situations, what are they indicating? They are indicating that the risks and rewards which are attached with the financial asset, those have been substantially transferred. And this is something which will have to be analyzed, as I told you, by going through the terms of the contract. Okay, yeah. So now what I'm doing is I'm coming back to the flow chart. In case the entity has not substantially transferred all of the risk and rewards, then what will the entity do? Has the entity retained substantially all the risk and rewards? If yes, then of course no derecognition will happen. If no, then the entity needs to check, has the entity retained control of the asset? If yes, then it will continue to recognize the asset. If no, then the entity will derecognize the asset. Means the last step involves understanding whether the control has been transferred or not. Okay. Now, I think we should get into one example to understand this in a better manner. So for this, I suggest all of you go to this illustration number 7. Because all of these steps are not known to us. We may not have understood each and every step very clearly, which is okay. So don't worry about it. When we will now look at some examples, we will start getting clarity. Okay, yeah. A financial asset is sold under repurchase agreement. The repurchase agreement means after some time it will be repurchased. The repurchase price as per the agreement is fixed price as first option, or sale price plus a lender's return is there. Let's look at 3 alternate scenarios. Repurchase agreement is for the same financial asset. Repurchase agreement is for substantially the same asset. Repurchase agreement provides the transferee. Transferee means who will transfer, who will get it. Repurchase agreement provides the transferee a right to substitute assets that are similar and of equal fair value to the transferred asset at the repurchase date. State whether the derecognition principles will be applied or not. Okay, let's get on to the solution. In each of these scenarios, the transferred financial asset is not derecognized because the transfer retains all the risk and rewards of ownership. Let's look at another scenario. Repurchase agreement provides the transferor only a right of first refusal to repurchase the transferred asset at fair value if the transferee subsequently sells it. In this scenario, the transferred financial asset is derecognized because the transferor has transferred substantially all the risk and rewards of ownership. So let's understand. So we have A and then B. A is the transfer, B is the transferee. Okay. Now what are we saying? Repurchase agreement provides the transfer. So A has transferred financial asset to B. Now there's a repurchase agreement. Repurchase agreement. Now what are we saying? Repurchase agreement provides the transferor, who's the transferor? A, only a right of first refusal to purchase the transferred asset at fair value if the transferee subsequently sells it. Now let's understand the flow of transaction once again, because this can be very confusing if you go by the language. That's why I've given you this chart. A has sold financial asset to B. Okay. A has sold financial asset to B, and at the same time, this is something which is happening simultaneously. A has entered into an agreement with B that A will repurchase the financial asset. A will repurchase the financial asset. Okay. Now in this case, can we say that A will de-recognize this financial asset? No. Why? Because this asset is coming back to A. If you look at A has not transferred substantially all the risk and rewards which are attached to this financial asset. These continue to remain with A. Isn't it? Even though sale has happened, A has a right to purchase it through this repurchase agreement. So that's why who is having the risk and rewards? It's A. Okay. But let's suppose if we say that A has sold the financial asset to B, yeah, but when this will be repurchased, repurchase means B will sell it. Repurchase agreement means B will have to sell it to A. Initially, the understanding was B can only sell to A. B can only sell to A at fixed price or sale price plus lender's return, whatever be the price. Okay, we are just ignoring that price. Now the fact has changed. Now we are saying that B will first offer this financial asset to A at fair value. It's not that this financial asset will come to A only. No. A will get right of first refusal. Yeah. A will get right of first refusal. In this case, what do we say? The transferred financial asset should be re-recognized because the transfer has substantially transferred all the risk and rewards of this financial asset. Why do we say that? Because now it's not necessary that the financial asset will come back to it. Because that's why A has kept this option available in the agreement with B. That tomorrow when B will sell it, then of course B will ask A. But if A refuses, it can go to any other party. So if this can go to any other party, that loophole has been given, that option has been maintained. So what would it mean? It would mean that substantial risk and reward have got transferred from A to B. Clear on this? Yeah. Let's look at another example. I'm hoping with this example, you must have got better clarity. And you will be thinking, sir, now this seems to be more clear. Yeah? Okay, great. So let's look at illustration number 8. A financial asset is sold and transferee has a put option. Again, let's put the names of the entities. Otherwise, it will become difficult. So financial asset is sold. Who is the transferee? B is the transferee. Every time you need to remember who is the transferee. B is the transferee. B has put option. Put option means B can sell it back. Correct? Put option means, put means to sell. Option means this option is available to B to sell it back. Let's look at some alternate scenarios. This put option is deeply out of the money. This put option is deeply in the money. Out of the money, in the money, you remember we discussed? In the money means favorable. Deeply means it's significantly favorable. Out of the money means not favorable. Okay? Yeah. So now in both these situations, when this will be deeply in the money or in the other situation when it will be deeply out of the money, how will the derecognition principles be applied? In the first scenario, the transferred asset. First scenario means when it is deeply in the money. When we know that the put option is deeply in the money, it is favorable to B. So what will happen? B will definitely sell it back to A. So in this first scenario, the transferred asset does not qualify for derecognition because the transferor has retained substantially all the risk and rewards. However, in the second scenario, when this is out of the money, will B ever sell it back to A? No. So in that case, this will get derecognized. Clear? Clear on this? Yeah? Clear on this? Let's look at another example, illustration number 9. So we can get on to another example, illustration number 9 quickly. A financial asset is sold and the transferor has a call option. Call option means option to purchase. Sold financial asset and this is the transferor. Transferor has call option. Means transferor has the right to purchase if transferor wants. Option means if either party wants. Call option is deeply in the money. Call option is deeply out of the money. What if the transferor holds a call option on the asset that is readily obtainable in the market? Call option is neither deeply in the money nor deeply out of the money. We need to comment on all of these scenarios. Yeah. So let's go one by one. First, call option is deeply in the money. So in this case, transferor will definitely purchase it back. So what do we say? Derecognition will be done? No. Second situation. Call option is deeply out of the money. So will A exercise this option? No. So what will happen? Derecognition will be applied. Correct? Yeah. In the third scenario, if the transferor holds a call option on an asset that is readily available in the market. Okay. Call option is neither deeply in the money nor deeply out of the money. So we are not going by that in the money or out of the money. So what do we do? In this case, asset is derecognized. Why? Because entity does not want to get this asset back. A has an option on an asset that is readily available in the market. So if A will want, A can go to the market and get this asset back. So do we have that specified financial asset which will be purchased back by A from B? No. Such financial assets are readily available in the market. So A will go to the market and buy it whenever it wants. So that's why in this situation again, derecognition will happen. Clear? All of you? Clear on this? Any questions, any doubts in case you have on this, please let me know. I would suggest you to attempt illustration number 10 along with the other two illustrations which I have given you as homework. All of you should practice this, huh? Because see, now we are moving towards conclusion in terms of derecognition also. Yeah, very soon we'll be done with derecognition also. So that's why I would say now we are reaching towards the end of major part of the financial instruments. So now it's very, very important that you start practicing all of these questions if you have not done that already. And it's very, very important that you start revising, because when you start revising, you may again face the challenges. You may again find some of the questions which we might have discussed in the class, but because we are around, so that's why it will be helpful for us to have a discussion on that. So that's why it's very, very important that you please start focus on this chapter, huh? If you have not been doing that. But I'm sure most of you will be doing that, but it's only for those who are not doing it. Okay, yeah. So if you have any questions now, please let me know, because we are now planning to conclude this session for today. So in the next session, we will continue with our discussion on the derecognition. We are not yet done with derecognition. Derecognition of financial liability is fully left. Financial assets is majorly covered. So we'll complete these two parts, and then we will also move on to impairment. That means expected credit loss model in the next session. So that's the agenda for the next session. Yeah. Any questions, any doubts in case you have, please let me know. Please let me know any doubts, any questions in case you have. No questions, no doubts. Yeah. All right. So then we can just conclude our discussion for today. Thanks to all of you once again for your time. Thanks so much. Yeah.